Hi everyone, today we're continuing our discussion on inventory costing. We are looking at the first in, first out method under the periodic inventory system. I'm your instructor, Brandy. If you've watched the other inventory costing videos, you'll notice that we're using the same data, and that's so you can compare the calculations across the different methods of calculating the inventory cost. Under the periodic method, we have to give you a little bit more information. You need to know the ending inventory count at the end of the month or the end of the year. In this case, we're giving you the inventory count information at January 31st, telling you that 575 units of inventory are remaining on hand on January 31st. And you'll recall that under the periodic method, we're not concerned with updating our cost of goods sold and inventory every single time we make a sale. We're only concerned with our inventory cost at the end of the month when we actually make our financial statements. So we can go ahead and ignore our sales transactions in this table. And I'm just going to make a note that we are under FIFO, first in, first out, and we're using a periodic method. Now remember, under inventory costing, our whole goal is to calculate cost of goods sold. And I'm going to go ahead and list out our beginning inventory, all of our purchases we made throughout the month. And you'll remember from your periodic income statement calculation of cost of goods sold that beginning inventory plus purchases equals your cost of goods available for sale. So in this case, we have 1,950 units available for sale. Now these are either going to end up in our ending inventory or in our cost of goods sold. We know that there are 575 units in our ending inventory, which means that 1,375 units need to end up in cost of goods sold. First in, first out, the method that we're using means that whatever we buy first, we have to sell first. So what we're going to do is we're going to start at the top with our beginning inventory, and we're going to move units into cost of goods sold until we reach this 1,375 units. So our beginning inventory of 500 units can go into our cost of goods sold. We're not at 1,375 yet, so we can keep adding to it. If we bring over the whole 750, we'll have a total of 1,250 units in our cost of goods sold calculation so far, so we can move the whole amount over. So far, we only have 1,250 in our cost of goods sold, and we need 1,375, so we need to move over 125 more units into our cost of goods sold. So those will come from our next purchase. We've now reached our 1,375 units in cost of goods sold for a total cost of $8,250, and I just got that number by adding up these costs here. Now I can go on and calculate what's left in my ending inventory. If I look at my beginning inventory, I've taken all of my 500 units and I've sold them, so there's nothing left in my ending inventory. If I look at my January 7th purchase of 750 units, that entire amount is going to my cost of goods sold, so I have nothing left in inventory. If I look at my January 20th purchase, I purchased 400 units. Of that, I put 125 into cost of goods sold, which means that 275 units are left in my ending inventory. And those were $4 a unit. For my January 27th purchase, I had purchased 300 units, and I hadn't taken any of those to cost of goods sold. They are all still remaining in my ending inventory. So in my ending inventory, I have 575 units, and that matches my inventory count. And the total cost of that is $2,900. And this could show up on your income statement. You could have your beginning inventory plus your purchases equals your cost of goods available for sale minus your ending inventory to give you your cost of goods sold. And now that you've watched this video, you should know how to calculate the cost of goods sold under the first in, first out method in a periodic system. Thanks for watching, everyone.